All right, let's jump right into this explainer and look at a massive paradox in our current stock market boom. Think about it. Right now, the absolute most valuable companies on the planet are practically throwing open their doors, begging to sell you their shares. For decades, right? The best companies stayed private. They grew in the shadows, totally out of reach for everyday folks. But now, boom, we're seeing more money, bigger names, and crazier valuations than the market has literally ever seen. Now sure, to some, this feels like the ultimate opportunity to own a piece of the future. But if we pop the hood and look at the actual mechanics of these deals, a completely different reality starts to emerge. Honestly, it stops looking like a celebration and starts looking a whole lot like a trap.
So, to figure out why this might be a trap, we have to look at how markets actually work. Because let's be real, generosity in finance? Yeah, that doesn't exist. Every single trade needs a counterparty. If you're buying a stock, someone else has to actively want to sell it to you. Which brings us to the most crucial question you could possibly ask yourself right now. If these businesses are seriously destined to rule the next century, why on earth are the insiders, the people who know them best, in such a frantic hurry to hand them over to you?
Well, it all comes down to a massive information asymmetry. Look, if you strip away all the flashy press releases, an IPO or an insider sale is really just a trade between two very different groups. In one corner, you've got the founders, the early employees, and the VCs. They've seen every private metric, every internal headache, the real projections. They are literally the most informed people in the room. And in the other corner, the retail investor, the everyday buyer who is, by definition, the least informed. The smart money has looked at their own revolutionary companies and decided, you know what, we'd rather hold your cash than our own shares.
That brings us to part one, the dine and dash.
To really wrap our heads around what's happening today, we've got to look at a historical pattern. Benjamin Graham, the legendary father of value investing, had this great saying. He knew that just like poker players have tells, markets have tells too. He said the intelligent investor sells to optimists and buys from pessimists. It's the exact playbook of the smart money. See, average investors, they panic. They sell when the chart drops and everyone's rushing the exits. But the pros? They do the exact opposite. Wall Street insiders sell when the skies are blue. They cash out when the hype is deafening, public optimism is peaking, and buyers are practically kicking down the door. Because that is the exact moment you can squeeze the absolute maximum amount of cash out of what you're selling.
And this isn't just theory. This dine and dash move repeats flawlessly throughout history. Check this out. Summer of 2007, Wall Street is roaring. The founders of Blackstone take their company public and walk away with roughly $2.6 billion in cash. Just over a year later, the 2008 crash hits and Blackstone's stock plunges about 90%. I mean, talk about timing the exit. Or rewind to 1999, right before the dot-com bubble burst. A whopping 51% of all IPOs that year were jammed into a single sector, tech. Insiders made an absolute killing, everyday investors thought they were buying the digital frontier, and then, poof, $5 trillion in market value just evaporated. And hey, we saw this exact same movie play out again in 2021 with the $160 billion SPAC craze.
The wreckage left behind by these cycles is frankly staggering. A decade after that dot-com mania, researchers did a sobering study and found that only 29% of emerging growth companies that went public back then actually survived as independent public companies. 29%. The vast majority simply vanished into thin air. The shiny future retail investors thought they were buying, it straight up didn't exist.
And we can see this cycle of insiders selling at the absolute peak super clearly if we look at recent SPAC data. Remember 2021? Wall Street was pitching the public on these blank check companies, basically empty shells skipping the usual IPO red tape. The cash flooded in, triggering an insane 613 SPAC IPOs in one single year. But once the insiders grabbed their cash and pulled the rug, the companies that launched in 2021 shed an average of 67% of their value. So what happened the very next year? The number of SPAC IPOs cratered to just 86, a total free fall from 613 down to 86. The takeaway here is simple. When markets are euphoric, insiders are selling. When the hype dies, the selling magically stops.
Which leads us to part two, the AI spending gap.
So how does this historical dine and dash playbook connect to today's massive AI boom? Well, the first number we need to look at is $725 billion. That is what the biggest tech giants on Earth are on track to spend, building out AI infrastructure this year alone. That's a 77% jump from last year. We are literally watching the largest and fastest infrastructure build-out in the history of humanity. To really wrap your head around that scale, listen to this crazy analogy.
If you spent $1 million every single day starting on the exact day Jesus was born, going straight through the Roman Empire, the Middle Ages, both world wars, right up to today, you still would not have spent what big tech alone is planning to drop on AI in the year 2026. It breaks down to roughly $2 billion a day, or $23,000 every single second. It is an absolute, unprecedented technological arms race.
But when we actually look at the returns, there's a glaring, massive gap. While $725 billion is getting dumped into infrastructure, the entire AI economy, like all of it combined, only pulled in about $110 billion in revenue over the last 12 months. And remember, that's revenue, not profit. Basically, the entire AI economy earned back around 15% of what's being spent to build it. By any traditional financial metric, that is a wildly questionable ratio.
Now you might be thinking, okay, but surely the businesses actually using this AI are seeing a huge payoff, right? Well, the research says not really. A recent Deloitte survey showed that while 74% of organizations are hoping AI grows their revenue, only 20% have actually made it happen. MIT researchers dug even deeper into real corporate AI rollouts, companies spending serious cash to put this stuff to work, and they found an overwhelming 95% of them produced absolutely zero measurable return. Zero. So this gap between what's coming out and what's coming in is huge, and everyday companies are really struggling to justify the price tag.
Moving on to part 3, the OpenAI reality check.
Right now, the market is completely pricing in perfection, basically ignoring this massive spending gap entirely. Take OpenAI. They're still private, but leaked confidential financials paint a totally clear picture of what's going on. Yes, they brought in an impressive $13 billion in revenue. But look at the next line down. They are projecting a massive $38.5 billion net loss for 2025. Just let that sink in for a second. They're losing nearly 3 times what they're making, and it gets wilder. By their own internal estimates, they're projecting a cash burn of well over $100 billion between now and 2029.
And yet, despite those frankly terrifying fundamentals and historic net losses, blind market optimism has blessed the company with an $852 billion valuation. That is more than 65 times its revenue. The market has completely decoupled from reality. It's pricing these companies as if that giant chasm between spending and earning doesn't even exist.
Which brings us to our final section, Part 4, Dancing Until the Music Stops. So, what exactly happens when the music stops? With these valuations priced for absolute perfection, there's just a massive amount of room left for disappointment. There's a famous quote that perfectly captures the psychology inside these tech boardrooms right now. Back in the summer of 2007, just months before the entire global financial system cratered, Chuck Prince, the CEO of Citigroup, was asked about their super risky lending. And he didn't pretend the party was going to last forever. He basically admitted the opposite. He said, when the music stops, in terms of liquidity, things will be complicated. But as long as the music is playing, you've got to get up and dance. We're still dancing. He knew a crash was coming, but he also knew that whoever was left on the floor when the song ended would lose everything.
And honestly, we are watching that exact same high-stakes game of hot potato play out right now. The founders and insiders, they know that prices have sprinted miles ahead of the actual fundamentals. But they're locked in this incredibly expensive AI arms race, and they need deep pockets. They know someone eventually is going to get left holding the bag. So the only rational move for them is to hand off these overvalued shares right now, while the music is at its absolute loudest, to the most enthusiastic crowd they can find, the everyday retail investor in the US stock market.
Ultimately, nobody has a magic stopwatch. No one can tell you if this bubble is going to pop in a month, a year, or 3 years from now. But fundamentals, they always catch up eventually. The good news is, you don't need to know the exact date. Your best defense as an investor isn't trying to predict the perfect timeline. It's learning how to read the room. Because when that liquidity finally dries up and this historical cycle repeats itself for the 100th time, are you prepared for when the music finally stops?